Hey there, and welcome to the Property Wealth Podcast. We're really excited to dive into today's topic, which is all about subject to deals. A really interesting way to buy properties without having to qualify for a loan.
Absolutely, Sarah. It's a fantastic strategy that can open up a lot of doors for investors, especially for those of us over 40 who might be looking for new ways to build wealth in real estate.
Exactly. So whether you're a seasoned investor or just starting out, there's something here for everyone. We'll cover how subject to deals work, the benefits, and some tips on how to find the right opportunities.
And of course, we'll also touch on some potential pitfalls to be aware of because, every strategy has its risks. But with the right knowledge, you can navigate those waters confidently.
Right. It's all about being informed and making smart decisions. So if you're ready to explore this unique approach to real estate investing, let's dive in.
Let's do it. First off, let's break down what a subject to deal actually is. So, Sarah, when we talk about subject to deals, it's really about seizing opportunities, especially for folks over 40 who might be feeling the pressure of retirement timelines.
Absolutely, Mike. Many people in that age bracket are starting to think about how they can secure their financial future, right? It's not just about retirement savings anymore. It's about building real assets that can provide income and stability.
Exactly. And with inflation rising like it has, having tangible investments like real estate becomes even more crucial. People want to protect their wealth.
Yeah, and I think that's a big concern for many. They're looking for ways to not just keep up with inflation, but actually get ahead of it. Real estate has historically been a great hedge against inflation.
Right. And subject to deals can be a powerful strategy for that. You're essentially taking over someone else's mortgage without having to qualify for a new one. This can be a game changer for those who are, say, just starting to explore investments later in life.
Sure, it opens up doors, doesn't it? I've spoken with listeners who felt stuck because they thought they couldn't afford to invest in real estate. But with subject to deals, they realize they can step in without all those barriers.
Exactly. Let me give you an example. I talked to a couple, let's call them John and Lisa. They were in their early 50s and they had been renting for years, feeling like they missed the boat on homeownership. When they learned about subject to deals, they found a distressed property where the owner was struggling to keep up with payments.
Wow, that sounds like a classic scenario. Did they jump in?
Yeah, they negotiated with the owner and took over the mortgage payments without having to qualify for a new loan. Now they've turned that property into a rental, generating monthly income. Plus, they've built equity without the stress of traditional financing.
That's incredible. And I'm sure they feel a lot more secure now, knowing they're building wealth rather than just paying rent.
Exactly. And that emotional side of financial security is huge. When you're over 40, you start thinking about legacy and what you'll leave behind for your family. Real estate can be a powerful tool for that, especially if you can acquire properties without the usual hurdles.
Right. And with the market shifts we're seeing, it's essential to be adaptable. Many people are worried about a potential downturn. But those who have real estate can weather those storms better.
Well said. And if you think about it, when you're investing in real estate, you're not just building wealth for yourself, but also creating a safety net for your family. Imagine passing down a property that can provide ongoing income, or even just a place for them to live.
That's a strong point, Mike. It's about creating a legacy. And I think it's important for listeners to realize that they can start small. You don't have to dive into a big multifamily property right away.
Exactly. Even a single-family home can make a huge difference. And with subject to deals, you can often find motivated sellers who are eager to let go of their properties, especially in today's market, where many are feeling the financial pinch.
So true. And I can see how that could be really appealing for someone who's maybe not as tech savvy or doesn't have a lot of capital to start with. They can step in and take over payments, which feels a lot more manageable.
Absolutely. And there's also the emotional aspect of it, right? People want to feel like they're making smart choices with their money. When you have control over a property, it gives you that sense of empowerment.
Yes, definitely. And it's all about taking those steps towards financial freedom. I've heard from listeners who were skeptical about investing in real estate at their age, but once they start to see the possibilities, their mindset shifts completely.
That's the beauty of it. When you realize that you don't have to stick to traditional routes, it opens up a world of opportunities. Think about someone like Carol, who was hesitant to invest due to her age. After learning about subject to deals, she was able to secure a property without the stress of a large down payment or high interest rates.
That's amazing. It's like a light bulb moment for her. And I imagine that not only boosts her financial confidence, but also her overall well-being.
Exactly. When you feel secure financially, it impacts your quality of life. You're not just worrying about paying bills, you're focusing on building something for the future.
And I think that's what so many people want, especially as they approach retirement. They want to know they're not just surviving, but thriving, you know?
Yes, and with the current economic trends like rising costs of living and fluctuating markets, it makes sense to explore creative financing options like subject to deals. It's about being proactive rather than reactive.
Right. And as we move into discussing core strategies, I think listeners need to remember that it's not just about the numbers. It's also about having the right mindset and being open to new possibilities.
Exactly, Sarah. And that mindset shift can lead to incredible opportunities. So let's dive into how to effectively structure these deals and make them work for you. So let's dive into some core strategies for these subject to deals. One of the first things to consider is understanding the existing financing on the property, right?
Absolutely. So when we say subject to, it means you're taking over the existing mortgage, but the loan stays in the original owner's name. It's crucial to check the terms of that mortgage.
Exactly. You want to look for things like the interest rate, the remaining term, and any prepayment penalties. Those factors can really influence your decision.
And let's not forget about equity. If the seller has significant equity in the home, that's a good sign. You can negotiate their motivation.
Right, if they're motivated enough, they might be willing to leave some equity in the deal for you. A good rule of thumb here is to look for properties where the seller has at least 20% equity.
That makes sense. And how about property condition? What should investors keep in mind there?
Well, you definitely want to assess the property's condition before making any commitments. A simple checklist can help. Things like the roof condition, plumbing, and electrical systems.
Yeah, and it's often wise to budget for potential repairs. A good rule of thumb is to estimate around 1% of the property value for annual maintenance costs. So if you're looking at a $300,000 home, that's about $3,000 a year.
Exactly. And don't forget about the location too. You want to invest in a market that shows signs of growth. Look for indicators like job growth, population influx, or even upcoming infrastructure projects.
Right, those are all great signs. And when it comes to financing, how does that work in a subject to deal?
So since you're not getting a new loan, you're essentially stepping into the previous owner's shoes. But you still need to figure out how you're going to pay the mortgage, right?
Yeah, that's key. One option is to use your cash flow from other investments to cover the mortgage on the new property until you can refinance it.
Or you can look for private investors or partners who might be interested in the deal. This can help you leverage your capital.
And what about the 1% rule? Can you break that down for our listeners?
Sure. The 1% rule states that the monthly rent should be at least 1% of the purchase price of the property. So if you buy a home for $250,000, you'd want to rent it for at least $500 a month.
That's a great benchmark. But what if you're in a market where rents are lower?
Good question. If rents are lower, it might not be a good investment. You might need to consider the long-term appreciation potential instead.
So it's about balancing those numbers, right?
Exactly. And another rule of thumb is the 50% rule, which says that about 50% of your rental income will go toward expenses. That includes property management, maintenance, and vacancies.
So if you're getting $2,500 in rent, you'd want to budget around $1,250 for expenses.
Right. And keep in mind that these are just rules of thumb. They can vary based on your specific market conditions.
And how about evaluating the deal? What steps should someone take?
Well, first, you want to analyze the cash flow, calculate your monthly mortgage payment, subtract that from your expected rental income, and then factor in your expenses.
That gives you a clearer picture of your net cash flow, right?
Exactly. And then you might want to consider the cap rate, which is the ratio of your net operating income to the property purchase price.
So if you buy a property for $250,000 and it generates $25,000 a year in net income, your cap rate would be 10%.
Yep. A higher cap rate often indicates a better return on investment, but you also need to consider the risks involved.
So it's kind of a balancing act again, huh?
You got it. And always remember to look at the bigger picture. Think about your overall portfolio and how this property fits into your long-term goals.
That's really helpful. And once you've evaluated the deal and decided to move forward, what about the paperwork?
Great point. You'll need to draft a purchase agreement that clearly outlines the terms of the subject to deal. Make sure to include things like the existing mortgage details and any contingencies.
And you might want to involve a real estate attorney to help navigate those waters.
Absolutely. It's always a good idea to get professional advice, especially if you're new to these kinds of transactions.
So as we wrap up this section, let's touch on some common pitfalls.
Good idea. One major pitfall is assuming that the existing mortgage is assumable. Not all loans allow for this, so it's crucial to verify that up front.
Yeah, that could really throw a wrench in your plans if you don't check.
Exactly. And keep an eye out for due on sale clauses. These could trigger the lender to call the full loan balance if they find out about the transfer.
Wow, that's definitely something to be aware of. I think we've covered some solid strategies here.
For sure, and knowing these rules of thumb can really help investors make informed decisions in the subject to world.
I'm excited to continue this conversation in our next segment.
You know, Sarah, one of the biggest pitfalls I see with investors, especially those new to subject to deals, is over-leveraging. It's like they get so excited about the potential of a property that they stretch themselves a bit too thin financially.
Yeah, I can see how that would happen. It's easy to get caught up in the numbers, right? You think, oh, this property can cash flow $500 a month, but then you forget to factor in unexpected costs.
Exactly. Like, I had a client who bought a property subject to, thinking it was a slam dunk. They saw the potential cash flow, but didn't really consider the maintenance costs. Turns out, the roof needed replacing just a few months after they bought it.
Ouch. That can really cut into profits. So what should investors be looking for to avoid that?
Well, for starters, always have a reserve fund set aside. You know, something like 3 to 6 months worth of expenses. And do your due diligence on the property. Get a good inspection.
Right. Speaking of due diligence, how about bad tenants? That's another common issue, isn't it?
Oh, absolutely. I had a friend who inherited a rental property and didn't do a background check on the tenants. Long story short, it ended up costing him thousands in evictions and repairs.
Wow, that's tough. So what do you recommend when it comes to screening tenants?
Always check references and run background checks. I also suggest meeting them in person, if possible. You can get a feel for someone in a conversation, you know?
Makes sense. And what about cash flow? I feel like that's a crucial aspect that sometimes gets overlooked, especially in subject to deals.
For sure. Some investors get so focused on the acquisition that they forget to analyze ongoing cash flow. I remember another client who bought a property thinking it would be easy to rent out, but the local market shifted, and they ended up with a vacant unit for months.
That's a tough lesson. So what do you think they could have done differently?
They should have done market research, really. Look at rental trends and vacancy rates in the area. If the numbers don't add up on paper, it might not be a great investment.
And then there's the classic mistake of timing the market. I know a few people who have tried to time their purchases perfectly.
Yeah, that's a slippery slope. I had a colleague who waited for the right moment to buy a property. Well, that moment never came, and the prices just kept rising.
So what advice would you give to someone who's trying to time the market?
Focus more on the fundamentals. Look for properties that fit your investment strategy, rather than waiting for the perfect moment. The right deal can often be found, regardless of market conditions.
That's a great point. And then we can't forget about hidden costs. They can sneak up on you, can't they?
Oh, for sure. I had a client who didn't account for property taxes or insurance increases. When those bills came in higher than expected, it really threw off their budget.
Yikes. So what can investors do to prepare for those hidden costs?
It's all about being thorough. Get estimates on taxes and insurance before you buy. And don't forget to factor in property management fees if you're not planning to manage it yourself.
And I imagine that having a good team of advisors can help with all of this, right?
Absolutely. Having a solid real estate agent, a good attorney, and maybe even a financial advisor can really help you navigate these potential pitfalls. They can offer insights you might not have thought of.
And what about spotting red flags? Are there any telltale signs that could indicate a deal is going south?
Definitely. If the seller seems overly eager to close quickly, or if they're avoiding questions about the property's condition, those are big red flags. Always trust your gut.
Yeah, I think that's so important. Sometimes, if it feels off, it probably is.
Exactly. And if you notice multiple issues during the inspection, or if the numbers don't make sense, don't be afraid to walk away. There are always other opportunities out there.
So if someone finds themselves in a tricky situation like they've over-leveraged or ended up with bad tenants, what steps can they take to recover?
First, take a step back and assess the situation. Look at your budget and see where you can cut costs. Sometimes, you might need to sell a property or refinance to get back on track.
That sounds like a smart approach. And what about finding better tenants or managing properties more effectively?
Well, if you've got a bad tenant situation, it might be worth consulting a property management company. They can handle the hard stuff for you and often have better resources for screening tenants.
That makes sense. It's all about putting yourself in the best position to succeed.
Exactly. And remember, every setback is an opportunity to learn. Real estate investing is a journey, and the more you navigate these pitfalls, the better you'll get at spotting them in the future.
That's such a great way to look at it. So as we wrap up this section, what's the key takeaway for our listeners today?
Just be diligent, do your research, and don't rush into anything. Real estate can be a powerful tool for wealth building, but it does require patience and careful planning.
Well said, Mike. It's all about being prepared and staying informed. So what's next on the horizon for our listeners?
So now that we've talked about subject to deals, let's dive into some practical steps that listeners can take right now, right?
Absolutely. I think the first thing to do is really just to start familiarizing yourself with the concept. A great way to do that is to read some books on creative financing or real estate investing.
Yeah, one of my favorites is the book on managing rental properties by Brandon Turner. It's super practical and gives you a good foundation for managing your investments, which is crucial when you're looking at subject to deals.
Oh, for sure. And there's also Investing in Real Estate by Gary Keller. It's a classic and really dives into the strategies that can help you understand the market better.
Right, and I'd also recommend checking out some podcasts. BiggerPockets has a ton of episodes dedicated to creative financing strategies. They often share real-life examples, which can be really motivating.
Definitely. And, getting your hands on some tools can make a big difference too. For instance, apps like Zillow and Redfin are great for checking property values and understanding the market.
Exactly. And if you're looking to analyze deals, the BiggerPockets calculator is a fantastic tool. It helps you run the numbers quickly to see if a deal makes sense.
Oh, I love that one. And then there's DealCheck, which is another great app for analyzing rental properties and flips. You can even use it to compare multiple properties side by side.
And don't forget about Rentometer. It gives you a quick look at rental rates in a specific area, which can help you determine if a property will cash flow well.
That's such a useful tool. And if you have access to your local MLS, that can be a goldmine for finding properties that might fit the criteria for a subject to deal.
Exactly. So once you're familiar with these tools, I suggest setting a goal for yourself. Maybe commit to analyzing one deal per week.
That sounds doable. You can even start with properties that are listed on the market. Just pick one and run the numbers.
Yeah, and make it a habit to jot down your thoughts, like what you like about the property, what concerns you have, and whether it could potentially be a subject to deal.
Right. And joining a local real estate meetup can be a game changer too. It's a great way to network and learn from others who might be doing exactly what you want to do.
Totally agree. Meeting people in the industry can provide insights you won't find in books or online. Plus, you might even find a mentor who can guide you through your first deal.
Oh, and don't forget the power of social media. There are tons of Facebook groups and forums where you can connect with other investors. Just make sure to engage and ask questions.
Yes, being active in those communities can really help you stay motivated and informed. And remember, start where you are.
Exactly! Don't feel pressure to dive into a huge deal right away. You can start small, maybe even shadow someone experienced before making your first move.
And if you're feeling overwhelmed, that's perfectly normal. Just take it one step at a time, focus on learning, and the confidence will come.
Well said. And, it's also a good idea to keep a journal of your journey. Documenting your thoughts and progress can really help you see how far you've come.
Absolutely. It can also help you identify areas where you need to improve or learn more.
And speaking of learning, maybe consider setting aside some time each week for training. Whether it's online courses, webinars, or even just watching tutorial videos, it all adds up.
For sure. There are some great online platforms like Udemy or Coursera that offer courses specifically on real estate investing.
Yeah, and don't forget YouTube. There are so many knowledgeable people sharing their experiences and tips for free.
Exactly. Just be sure to vet the sources and find reputable channels.
Right. And one more thing. Set your intentions. Create a vision of what you want your real estate journey to look like.
Yeah, having that clear vision can guide your decisions and keep you focused on your goals.
So those are some practical first steps. Now let's bring this all together.
All right, so as we wrap up, let's just recap some of the key takeaways from our discussion on subject to deals.
Yeah, definitely. So the first point is how subject to deals allow you to acquire properties without needing to qualify for a traditional mortgage, right?
Exactly, and that can really open up opportunities for investors, especially for those who might not have the best credit or are just starting out,
Right. And then there's the potential for creating cash flow, which is super important if you're looking to build long-term wealth. You can take over existing financing and still generate income from the property.
Absolutely, and let's not forget about the flexibility it offers. You can negotiate terms that work best for you and the seller, which can sometimes lead to better deals overall.
And the importance of doing your due diligence can't be stressed enough. Understanding the existing mortgage, the condition of the property, and any potential risks is key to making informed decisions.
For sure. And, taking the time to really understand these deals can set you up for success. It's all about building that foundation for long-term wealth.
Yes, and I think that's really what it all comes down to. Real estate can be a powerful tool for building wealth, especially if you approach it with the right mindset and knowledge.
So, if you enjoyed today's episode, don't forget to like, subscribe, and let us know your biggest takeaway or any questions you might have in the comments.
And share this episode with someone over 40 who's looking to invest in property. You never know who might benefit from this information.
Next time, we'll dive into lease options, which is another fantastic strategy for controlling properties with little cash. So stay tuned for that.
We're excited to see you then. Until next time, take care and happy investing.
Goodbye, everyone.
Bye.